Join me at CMC.
Get engaged and get educated.
Join me at CMC.
Everyone is welcome.
Join me at CMC.
Come grow your relationships.
Join us at CMC.
CMC is real,
Authentic conversation.
Engage with curious people.
Plus, we give you access to thought leaders.
Be informed, be inspired.
Through community conversation.
Come here and meet your neighbors.
Be here in the room.
ask questions,
Get answers.
Connecting people and ideas.
Learn about Columbus.
Who will you see at CMC?
Join me at CMC.
You're invited.
Watch us on live stream or in person.
You're invited.
Join the conversation.
You're invited.
Welcome to CMC.
All right. Yes. Hello, everyone. Happy New Year. And that means it's time to get started. Everybody take your seats. All right. Thank you, Jane. Welcome to the Columbus Metropolitan Club. Founded in 1976 by 13 visionary women leaders, CMC's mission is to connect people and ideas through community conversation. To carry out its mission, CMC explores public policy issues, current events, and lessons in leadership at forums like today's every Wednesday. From its beginning, CMC has welcomed everyone. I'm Kelly Atkinson, the Director of Business Systems at Barnes & Thornburg and Chair of CMC's Board of Trustees. We're so pleased you're all with us today. Let's begin by meeting our newest CMC members. So please welcome Joanne Bratka with Delta Airlines, Teresa Byers with Park National Bank, Jeffrey Corzine with Humana Healthy Horizons in Ohio, Dick Dexter at Huntington, Stokely Anuba with Gift Health, and a special welcome to our newest lifetime members, Brian and Jody Urbanski, Urbanski Abry, Affordable Housing Foundation. All right, let's welcome everyone, please. And if you are not already a member, the big question for you is, have you already made a New Year's resolution? No, just kidding. But I do think that you should at least consider it. CMC membership is not expensive if you even thought that it was. It is less than $17 a month and well worth every penny. Please also take a moment to look at the backs of your forum flyers. You'll see the organizations that provide the not-for-profit Columbus Metropolitan Club with half its annual revenue. To join these sponsors, please see Lainey Cuthbert with CMC. Lainey's walking around. There she is. All right. And she will help you out. Before we begin, we'd like to thank today's forum sponsors as well. We have BDO, Delta Airlines, Fifth Third Bank, and Ian Alexander Photography. Thank you to the Center for Human Kindness at the Columbus Foundation and the Columbus Dispatch for presenting today's live stream as well. So let's thank all of today's forum sponsors. Let's get 2023 started with CMC's annual Blue Chip Economic Forecast. What's in store for Central Ohio's economy this year? While the immediate economic impacts of COVID seem to be subsiding, inflation was setting records in the US last fall. Today, we'll hear what the year ahead looks like for Ohio's economy from a terrific panel. To introduce today's speakers, please welcome Stephanie Green with today's sponsor, Fifth Third Bank. Stephanie, welcome.
Thank you, Kelly, and thank you, Columbus Metropolitan Club. It's certainly wonderful to be back again in support of CMC. And now, since I'm a veteran at this, I've learned not to allow Mark Williams to include any bad economist jokes in my remarks. So sorry, Mark, but you all can thank me later. My name is Stephanie Green. I'm the managing director of Fifth Third's private bank. And we are proud to continue our sponsorship of the Columbus Metropolitan Club as we convene these weekly conversations on important community topics. We are better as a community when many of us come together to discuss these matters of our times. stock market volatility, a rising rate environment, and a looming global recession are just a few of the economic matters impacting the economic reality of Americans. Predicting the future is tricky business, but listening to our trusted experts for insight, good data, and guidance will aid us as we look ahead. And now, please allow me to welcome our experts and distinguished speakers that will guide our discussion today. First, we have Ms. Kathy Bostjancic, Chief Economist at Nationwide Mutual, Dr. Bill LaFayette, owner of Regionomics, and our host and bad joke teller, Mr. Mark Williams, business reporter for the Columbus Dispatch. You can learn more about today's speakers in your forum flyers. Before we begin, Dr. LaFayette, would you please look into your crystal ball and tell us what we can expect in 2023? Bill, take it away.
Thank you. Well, good afternoon and Happy New Year to all of you. Thank you very much for being here. And for those of you streaming now or later, thank you very much for tuning in. A special thanks to those of you out there who've bought virtual seats. Thanks to our sponsors, and a big thanks to my friends at CMC for making this forecast the first forum of the year now for 22 years. I have to tell you, it is so good to see a full room here week after week now. Last year, when I did this forum, the audience was limited to maybe 125. 2 years ago, we recorded the forum in front of around 12. So we have come a very, very long way. And as we start 2023, I have good news for you and bad news. The good news is that average employment this year may be higher than it was in 2022. The bad news is that employment is likely to be in decline for part of this year. This year's average versus last year's average depends on both this year's and last year's monthly trends. So my forecast for 2023 is for a net gain of 10,300 jobs, or 0.9%. That brings us in the metro area to 1.136 million jobs. And that sounds pretty good under the circumstances, but it's really not. There are two surveys of national level forecasts that I follow. One from the Philadelphia Federal Reserve and one from the National Association for Business Economics. The job change projections of the economists in those two surveys imply a year-over-year national gain of 1.4 to 1.5%. Much of the difference comes from last year's trends. It looks like we wound up with a 2022 gain of around 2.4%. The US gain was 4%. Our weaker performance was fairly widespread, notably in 4 key sectors that are our bread and butter around here: finance and insurance, business services, healthcare, and state government. The problem seems to have been in workforce availability. The most recent numbers on job postings from Ohio Means Jobs show more than 67,700 openings in Central Ohio as of mid-November, a 26% gain from November 2021. Postings were steadily increasing for much of last year. This is a big worry. If employers can't fill their open positions, they can't operate efficiently. Their revenues and profits suffer, and so does our region's economy. I've been up here in previous years whining about the inaccuracy of the employment estimates that we get every month from the Bureau of Labor Statistics. The 2022 estimates seem to have been even further off than usual. I've had to adjust most of those estimates, and I adjusted most of them upward. The raw estimates from the federal government imply a 2022 gain for the Columbus area of 2.1% rather than my 2.4%. So you need to take the 2022 numbers with a fairly sizable grain of salt. We're going to know more when revisions come out in March, but there's no doubt that regions elsewhere did better last year than we did. As you might have heard, Intel has a small project going up in New Albany. They're already moving dirt, and hundreds of construction workers are on site. That activity is already visible in the construction employment estimates. Construction's going to be a bright spot this year. The first 2 microchip fabrication plants, or fabs, will open in 2025 and employ around 3,000. Hiring for those has already started. There were more than 900 Intel job openings posted in Central Ohio this past November. Meanwhile, construction employment is going to peak at 7,000. But that's just the start. If we stay on our best behavior, we could wind up with 6 to 8 more fabs opening over the next decade, implying 12,000 to 15,000 jobs by the mid-2030s. Construction employment is going to stay well up into 4 figures for this decade and beyond. Needless to say, this is going to be transformative for our region and for the state. I've been thinking through the implications of all this ever since the news broke last January, as has Mark, as have a bunch of other folks. As a board member of the Mid-Ohio Regional Planning Commission, I've been collaborating with my friends there to figure out the impacts on employment and population. The crucial unknown is what the employment will be among suppliers and businesses supporting workers' households. A recent Intel report estimates that total jobs in Arizona, New Mexico, and Oregon, where operations currently exist, are 5.1 to 5.7 times the direct Intel jobs. My argument is that Ohio's economy is larger and more diversified than those 3, so the employment impact in Ohio should be at least that big and probably bigger. Intel wants its primary suppliers nearby, and the site's designed to support a good many primary suppliers. So the bulk of the indirect impacts should be right here in Central Ohio. I've been thinking in terms of a total regional jobs impact of maybe 4 to 4.5. That suggests a total Central Ohio impact of 12,000 to 13,500 jobs in a few years, jobs that we would not have had Intel not started operations, and possibly as many as 67,000 when all's said and done. And that doesn't include the construction jobs. So what will the Intel jobs look like and what will they pay? That was the first question I tried to answer last winter. Let me make it clear that this analysis comes from work with the government's occupational statistics on the semiconductor manufacturing industry, not from Intel. Intel has promoted an average pay of $135,000 a year, but that includes benefits, and for statistical reasons, it's higher than what the typical worker is going to earn. My analysis suggests that about half the jobs in the semiconductor manufacturing industry are open to people with high school diplomas plus a year of training. some of which Intel will provide, some of which our community colleges will provide. Even if Intel pays well above market, and they will, as a third of the jobs are going to be paying less than $50,000 a year. That's actually really good news. It suggests that opportunities at Intel and its suppliers will be open to a broad segment of our workforce. These workers can expect to earn far more at Intel and their suppliers than in other jobs requiring the same skill level. But focusing on that $135,000 figure suggests that we don't have to worry about affordable housing and apartments for Intel workers. We definitely do. In all this talk about Intel, I haven't even touched on Honda's October announcement that they're going to partner with LG Energy Solution to build a $3.5 billion battery manufacturing plant in Jeffersonville in Fayette County, less than an hour from southern Franklin County. That's going to create 2,200 direct jobs. Meanwhile, Honda is going to add 327 jobs to its existing plants in Marysville, East Liberty, and Anna. Those jobs may wind up more than offsetting long-term losses elsewhere in the region's auto industry as production shifts from gas-powered vehicles to electric ones. So while we may be in for a bumpy ride this year, the long-term future looks bright for Central Ohio. Thanks again for being here in person or virtually, and I wish you all a happy, healthy, and prosperous 2023. Mark, take it away.
Happy New Year to everybody. Bill, thank you for that cheery and uplifting forecast. And Kathy, welcome to our group. It's a pleasure to have you. I think this will not be the last time that you see her at this forum. And thanks again to the CMC for having me back to moderate the Bill's forecast. This is always a lot of fun. When I stood before you a year ago, I had this big, huge secret, and I really wanted to tell you, but I just couldn't. Of course, we now know what that big secret is, that Intel is coming here, $20 billion investment in Licking County, the state's largest economic development project. You heard Bill on the numbers on thousands of jobs at the plant and with suppliers and indirect companies. We all know that we live in a state where we make things. What we don't make, though, is semiconductors. These teeny tiny little devices that run all the stuff that is so critical to our economy today, whether it's cell phones, cars, appliances, military equipment, and so much more. Even my new battery-powered lawnmower uses semiconductors to determine how fast the blade should spin to cut the grass in front of me. As Bill notes, this new industry promises big changes for our local and state economy. Jobs Ohio expects the project will add a gigantic $2.8 billion to our economy every year. Over the summer, I was among several members of the Central Ohio media that got a chance to go to Intel, go to see Intel's operations in Arizona and talk to officials in the town of Chandler. We can get a lot of cues about what's coming our way by studying what has happened with Intel in Chandler over the past decades. Intel's presence there is powerful, I got to tell you. It ripples through schools where volunteers tout the value of a technical education, to Chandler stores and restaurants where high-wage workers spend their money. It's been a fascinating story to cover over the past year, but we do have to acknowledge that this development comes with a heavy cost to the people who live in the Johnstown area and western Licking County. They live where they live because they like the scenic, quiet beauty of the region. These plants mean more traffic, people, and higher housing costs. And it will be on Intel, our government agencies, and our region's economic development leaders to address the concerns of these neighbors. A lot has happened in the past year since that big announcement, and a lot of it good in the semiconductor business. Intel stock is basically cratered. Demand for these tiny devices that we talk about has been weak in a slowing economy. And Intel's not alone. Other semiconductor companies are having the same problems. Yet Intel believes that demand for these computer chips will rebound and grow over time. So it's critical that it be ready when it does, and that's why the New Albany project is so important. The weakness in the semiconductor industry is just one of the many mixed messages our economy is putting out right now. We all know about inflation and how big of a concern it's gotten over the past year. It's running so hot that even the tooth fairy has been raising prices. The cost has jumped 14% to $5.36 per lost tooth, according to the original Tooth Fairy poll. The price of a dozen eggs has jumped 49% over the past year. I paid $3.49 for a dozen eggs the other day at Kroger. Yet gasoline is back to $3 a gallon. Unemployment rates are low, 2.7% in Columbus in November, which is basically zero for all intents and purposes. And you heard Bill talk about how hard it is for employers to find workers. At the same time, we're seeing layoffs in some industries, especially the tech sector. And here in Columbus and across the country, Salesforce this morning announced it was laying off 10% of its workforce. The steep rise in interest rates over the past years has dramatically slowed home sales in Columbus. But again, at the opposite end, housing prices are still expected to go up. To make things even more confusing, we're hearing a lot of jargon from economists and financial experts trying to help us figure out our way. And so we get these terms like hard landing, soft landing, hiking cycle, pause, pivot, stagflation, quantitative easing, quantitative tightening, and my favorite, the dreaded inverted yield curve. The term sounds like something that the Republicans are doing in Washington today when they try to pick a new Speaker of the House. So what are these mixed messages telling us? Are we headed into a recession? And if so, how bad will it be? Will it be like the powerful one we saw in the early days of COVID, or something more mild than what you would expect that we have seen over the past 50 or 60 years? The good news is we have Kathy and Bill to help us figure all this out. So Kathy, why don't you kick off our conversation with your national outlook and all these things that we're talking about with inflation and interest rates and all that.
Yeah, thank you, Mark. And thank you to Jane and CMC for having me here today. Very pleased to be speaking to all of you. And just to add, I've actually been at Nationwide, started just 2 months ago. So really pleased and to be at Nationwide and also to learn a lot more about Columbus and the greater Ohio economy. So, where do we stand amid all the jargon and concerns? I have to say that, I worked many years on Wall Street. So the fact that this has been the most anticipated, talked about recession ever kind of makes me want to go on the contrarian part of that view and say it's not going to happen, right? That when it's so, and it is typically the case when people think they see something coming, it's the things that you don't see that typically trip you up. So it's sort of like waiting for Godot. Where is this recession after all? So of course we don't want recession, and I think the Federal Reserve is trying to do its best, and Chairman Powell is the head of the Fed currently, to avoid a recession and to navigate. And recession is just, a hard landing is another word for recession, right? And then it's a question of how, if we do have a hard landing or recession, is it mild? Is it moderate? Is it severe? That's the other part of this. It kind of reminds me of after, the great financial crisis, or even COVID, are we going to have an L-shaped recovery, or is it going to be this elongated U? So we like to try to grasp, to understand what's going on with these sort of symbols. But, the Federal Reserve is hoping to cool things down just so, right? So to have this sort of Goldilocks economy where we take some of the froth out of labor market. Bill talked about that. This morning we had job openings data that was released for the month of November. Job openings haven't declined at all. We're still seeing a tremendous number, over 10 million job openings nationally. And when you look at the ratio of job openings to number of unemployed people, it's still very high. It's just under 2. So that means for every person unemployed, there are 2 job openings, theoretically they could choose from. So our own view nationwide is that the Fed, though, has a tough challenge. They always want to navigate sort of this Goldilocks or soft landing outcome. And it's always their goal, but inevitably that's not the case, right? They have just the interest rate, and now they have the balance sheet tools to try to fine tune things. But those are really kind of blunt instruments when you think about how complex the national economy and regional economy is. So our own view is that we are likely to see the Federal Reserve raise interest rates to above 5%, hold them for the full year to try to cool inflation down. So goods inflation is coming down, but the services side, right, that's where things are sticky, and it's going to be a little bit more difficult for the Federal Reserve to try to navigate. And that's also linked to the labor market. All kind of comes full circle. As long as the labor market stays really strong and wage growth keeps rising, it's over 5%. Pre-pandemic wage growth was 3%. That feeds into, as you can imagine, the service side, a cost structure, right? A service part of the economy is very labor intensive. Right now, service companies, many surveys show they could still pass on price increases. So as long as that dynamic's in play, the Federal Reserve sits there and says, oh boy, actually things are still too hot. It's great to have a strong labor market, but when it's too strong or you can't find enough workers, then it puts pressure on wages and inflation. And in the medium to long term, that's the worst outcome for the Fed Reserve. Chairman Powell, really in the back of his mind, doesn't want to be Arthur Burns. If you don't know Arthur Burns and the Federal Reserve, the experience in the 1970s, I encourage you to Google it and read about it. But back in the 1970s, the Fed Reserve tried to tame inflation, but then worried about economic growth slowing. So it said, okay, well, we've got to ease back. We don't want to drive the economy into, hard landing, recession. But then what happened is inflation just persisted, right? And then it continued into the 1980s. We had the double dip recession. So really the Federal Reserve, Chairman Powell saying the worst outcome really is if inflation persists. Again, they don't want a recession. They're trying to avoid it. They're hoping they could just take enough froth out of the labor market. But our view is that that's not likely to happen. The good news, though, is we don't think the recession that we see starting in the second half of this year is going to be very severe. And the reason is because you do have strong dynamics. You do have strong labor market. You also have consumer and corporate balance sheets that are actually in pretty good shape right now. And that's not always the case. So, and the Federal Reserve, eventually, if inflation comes down, can start to lower rates. So again, recession, but more moderate is what our view is, and that's the second half of this year.
All right. So Kathy, I want to follow up on your outlook. Now, this is a bit of a reach, so you tell me whether I'm sound here or I could need to do some more homework. Now, you were talking about Jerome Powell and the guy that runs the Federal Reserve, and I want to compare him to the movie The Godfather. So everybody knows that famous scene, not the one with the horse, the famous scene where Sonny Corleone gets shot like a gazillion times, right? Now, I suspect that the rivals to the Corleone family could have done this in a way that might have been, I don't know, maybe less violent. But the rivals wanted to send a message, and they wanted to do it dramatically, so they did. And it seems to me that we run the same thing risking with Powell here, that he is so wants us to send this message that he's going to do whatever he can to stop inflation by continuing to raise interest rates, even if that means higher unemployment, a lower stock market that we all depend on for our retirement, failing or lower house sales. So how do you see you have to kind of balance this so he goes and gets what he wants without making us all not like Sonny Corleone?
Thanks, Mark. I think Powell wants to, if he can, avoid any comparison to the Godfather movie. That said, you make a good point in the sense that, Chairman Powell does have to talk tough right now, right? So really, if we, go back, let's say, 2 years ago, there was a tremendous amount of fiscal and monetary policy, right, put into the economy. And then that was because things looked pretty bleak and there was a great amount of uncertainty. And you could argue that maybe that went too far, right? And then you ended up juicing up the economy, prices, and that's really why we have, at a time when supply was constrained because of supply chain issues. So you had demand that was boosted by all this fiscal monetary policy, supply constrained. Larry Summers was right. That was too much stimulus, and now we have the inflation to pay for. But now but for a time period, Chairman Powell and others thought it was going to be transitory, this inflation. Now they realize, clearly, for a while now, they've realized that it hasn't been. And the question is, are they swinging too far, the pendulum the other way? And I think your point, Mark, is that they do need to talk tough. Now, whether they delivered or not, we don't know, right? We forecast, we analyze, and what they're telling us is we're going to keep rates at a very high level until inflation breaks. That I believe. The question is whether inflation breaks before that. I really do believe that even if the economy slips into recession, I don't think, as is usually the case, I don't think the Fed this time has the luxury of being able to bail out the economy, cut rates, unless they're pretty confident that inflation is cooling. But there is a debate about that. Some people think, well, maybe the Fed will say, 3% inflation is good enough, right? The target's 2%. So we'll have to see. We'll watch. Actually, the Federal Reserve releases its minutes today from its previous meeting. Market players will be watching that and watching Fed commentary. But there is part of that where he wants to talk tough, and hopefully it doesn't have to be that tough in reality.
So, Bill, one of the big questions I get about Intel is about labor and whether this region can actually produce the workers that Intel is going to need and all the suppliers that are coming here. Intel has committed $100 million to local and national higher ed programs to help build the pipeline of workers. It's already announced nearly $18 million over the next 3 years to fund projects with more than 80 Ohio colleges and universities. We also know how expensive housing has gotten around here, and I suspect it'll even get worse around those plants. So, I mean, just talk a little bit about how that dynamic is going to work with the ability of Intel and its efforts, and what all we need to do to make sure that we can keep that you can make sure everything gets staffed like it should.
Yeah, that's something that I've been very concerned about, quite frankly. What is going to happen, I think, is that there will be people who will be attracted here from the rest of Ohio, from the rest of the U.S., perhaps from beyond the U.S., assuming that we can do something about our immigration rates. But I think you're going to see longer commutes. I was doing a big analysis up in Marion County, and I told them, look, you can expect Intel workers here. We're looking at a huge labor shed for Intel. And before we even get to Intel, we have to accommodate the construction jobs. And you and I have talked about this. There are people who go around the country from construction job to construction job, and they get in their RVs and they park near the construction site, wherever it is, and they build the project, and then they move on to the next one. So there will be a fair amount of that. One thing to keep in mind is that 7,000 construction workers is about 15% of all construction workers currently in Central Ohio, and those folks are doing other things. So while we accommodate Intel, we have to keep building housing, which we've been underbuilding for at least a decade, putting in the roads and other infrastructure that's going to keep traffic moving, building the plants for the suppliers, which will be mostly here, but elsewhere in Ohio too. And so it is going to be a pull. There's no doubt about it.
Kathy, and just to follow up on that, generally this whole issue of trying to find workers nationwide has been a problem, as you just noted on the JOLTS report. Does that get any better this year?
gradually and slowly it does get better. But, not for necessarily, the reasons we'd want, right? So as the economy slows and really corporate profit growth continues to slow and eventually starts to contract on a year-on-year basis, corporate leaders are going to assess and try to cut costs. And one way to do that is to reduce, labor expenses. So they'll first probably, you see some of that already, stalling of new hiring, but eventually that will lead to layoffs. So that will help that ratio get in better balance, but it's because the number of unemployed will rise and also some of the job openings. It's not the best outcome, but the best that can be done right now.
Yeah. So, and one point to follow up on Bill's issue with, point with the construction jobs is that when I've written about this, so Bill's exactly right. So you're going to have like 3 groups of construction workers on the site. You have construction workers here in the area. Then you have construction workers that live an hour or 2 away that will come to the site every day. Then you have this third group that just like to travel around and go from project to project.
Like traveling nurses.
Yeah, exactly. Bill, I wanted to ask you another question about this project with Intel, but also with the Honda project. And we've seen several other big manufacturing announcements over the past several months. GM, Ford, Abbott with the new plant that they're going to build in Bowling Green. And we talk about the size of the number of workers for these projects, and we call them all transformative. But collectively, maybe they still only amount to a few thousand workers. And this is a term that I've even used this plenty of times with Intel. But are these projects, are they really transformative? Is there a way to kind of tell that?
Yes, I think they are transformative. We've had a below average share of manufacturing jobs in Central Ohio as far back as I can get data, and that's 1964. So we have always been below average in manufacturing. And we're going to continue to be below average, I think, even with Intel, even with these other projects. But it does balance our economy a little bit better than it was. It also makes it somewhat more cyclical because manufacturing is a fairly cyclical sector. But one thing that we can't minimize is the fact that Intel coming here, as opposed to anywhere else in the country that they could have gone, puts us on some lists that we weren't on before. It helps economic developers and site selectors and people wanting to site new plants and new facilities of all kinds to look at Columbus. And that, on the long haul, is, I think, going to be very, very good for us. The point being that we're going to attract a whole new workforce, create and attract. And that's going to make it a better sell for other similar operators to come here, much as it has over the decades in the financial services sector. It's going to make a difference, no doubt about it.
We're going to get to questions here in a couple minutes from you all and online. So if you have a question, please make your way to the microphone here in a little bit. Before we do that, I want to get one more thought from our panelists, and this is a more philosophical question than what we've done in the past. Everyone here knows One Columbus, right? Our economic development arm that drives all these projects like Intel. One Columbus has declared this bold goal of making Columbus the most prosperous metro area in the country. So One Columbus has used this as a notion to set its agenda for what it wants to work on in the coming decade. But the whole notion has gotten me to thinking about what it actually means to be prosperous. Is it strictly a capitalist notion, the most wealth created, the most jobs created, our population growth, or is it something different, pushing our economy forward while addressing racial and wealth inequities and inequalities, raising incomes for everyone, and tearing down barriers that keep people from working, and issues in housing, education, and transportation that we know so much about? Or maybe it's more personal, each family having a decent place to live with enough money to afford the basics in life and to be able to do all the things we want to have access to, such as education, healthcare, and affordable housing. So Kathy and Bill, I ask you how you would define prosperity.
Well, it is a big question. And I think, Mark, many of the points that you mentioned here are factors, and they all matter. I mean, strictly speaking, economists could look at financial well-being or economic well-being and look at something like GDP per capita, right? Like the amount of GDP per household or per person. But it is much wider than that, right? If you want to think of, you have to have availability to good schools, housing, as Bill talked about. So I think it encompasses much more. And I think you can't just strive for the greatest, largest amount of income. You have to have all the infrastructure and all those social benefits that are needed to go along with that to make people feel prosperous.
Kenny McDonald at One Columbus and the Columbus Partnership seems to be taking this broader view of what prosperity means. And I am absolutely delighted to hear that. Quite frankly, folks, we have work to do. Studies have shown that Columbus is far more economically segregated than average, and upward mobility here is less than average. And I actually think those 2 points are fairly closely related. Nationwide, it seems to me that the increasing economic gap is probably one reason for the increasing polarization of our society here in the United States. There's an interesting concept that came up in the 1970s in Bhutan, of all places, and it's called the Gross National Happiness Index. It's being studied now by the United Nations. It considers both economic and non-economic aspects of well-being. It's got 9 domains, and I've written these down. Let me read them off. Psychological well-being, health, education, time use, we might say the work-life balance, cultural diversity and resilience, good governance, community vitality, ecological diversity and resilience, and living standards. And the Gross National Happiness Index argues that you can only increase prosperity by improving all 9 of those domains. It's a false trade-off to say that I can only make myself better off by beggaring you. It's actually just the opposite. Now, I don't know how you measure some of these things at a local level, but I think that would be a really excellent framework for One Columbus to take to move us to a more prosperous society, he's trying to say.
All right. Let's get to our questions. You all know the rules about keeping questions brief and to the point, and that questions do, in fact, end with a question mark. So, Jane, what is our first question?
I have a lot of questions, and I'm going to ask as many as I can, and then just get in line behind me, and we'll do every other one. I'm going to combine some questions, too. Dr. Dick Myers and Kathy Fox both have questions about housing, affordable housing, and how are we going to get ahead of this? Bill, you mentioned we've been behind for 10 years. I'm going to put a caveat on that. How urgent is it to have the city catch up with their zoning code to allow more housing to get built?
That's really the point. I think a lot of our problem with housing has been outdated zoning codes, both in Columbus and throughout the region, some of which, quite frankly, have been driven by NIMBY. And we really have to dispossess folks of the idea that a large lot suburban development is the only decent housing alternative out there. One of the things that the Insight 2050 study pointed out is that the shifting demographics are going to promote more interest in denser development. And we have to do this or we're not all going to fit. So yes, it's very urgent. Zoning codes are very important. And this is something that we have to figure out. I'm really happy about the Columbus bond issue on housing passing.
Yeah, so one of the points I always tell people, we're going to have 1 million more people living here in the next, 12, 15 years. They have to stay someplace. Kathy.
I'm from New York City, so I'm very, very familiar with dense living situations. And you certainly, that has to be managed as well. But that does allow more people to live in an area. And sometimes, to be honest, just my own personal experience, I like living in a co-op. I have neighbors and people and people on the floor if I need something. But I think in general, housing, it's a national issue, right? And Bill and I spoke about this a bit. There's just a lack of supply. Some of it exacerbated from the great financial crisis, right? It was the things, housing collapsed and then the builders reassessed. And then of course, supply was slow to come online. And now it's really more focused on luxury because that's where the bigger profits are. So we have a national housing crisis that really we need to be addressing. And until then, even with a recession or mortgage rates going to 7%, home prices aren't going to fall dramatically unless we start to get supply coming online.
Hi there, my name is Andrea Applegate, and my company, Applegate Talent Strategies, we work with employers on their workforce and talent issues. And we are hearing and we're experiencing high wage growth. And at least anecdotally, we hear that employers are giving frequent pay raises. And I'm curious, what advice would you have for employers who are doing that? And what are the consequences, unintended or otherwise, on the economy and on, and they're doing this not just to attract and retain their talent, but also to ensure that their employees are keeping up with inflation. So there's, it's good on both sides, but what advice do you have for employers?
I will.
Yeah, go ahead.
Okay. Pay is only one thing. And you and I, Andrea, have talked about this a lot. You have to make sure that employees are engaged, happy, and feel able to take risks, feel like they're contributing. Otherwise, they are going to leave. Pay is one thing. It is certainly not the only thing, but it's certainly one reason why we're seeing the inflation that we're seeing. It's what we learned in Econ 201. You have inflation when too many dollars chase too few goods.
And I would just add, I agree with Bill, and I would just add that really that's what the Federal Reserve is trying to do, right, is cool off the labor market. What they're really worried about is this next stage could become a price wage spiral, because up until now, I would say that most of the inflation was not caused by higher wages. But we're now moving to a period where it could sustain and help higher inflation persist. And that's where the Federal Reserve wants to, cool the labor market down. And there's really no other way to do that. They hope to do it gently, but that may not be the case. In terms of advice, it's really difficult, I think. I mean, I agree with Bill, but I think there are a significant number of people, right? And if you're looking at your cost structure and you may even have wonderful benefits and be valued, but if you can make a significant amount of money somewhere else, that's going to be very enticing. And I think that's difficult to manage, frankly.
We will have an ongoing workforce shortage for the next 10 to 15 years. It's just demographics. And I modeled a recession before the pandemic to see what that does to the workforce shortage. It addresses it, it doesn't cure it. And at the end of the recession, it's going to come back in spades.
So Marla Jones has this question. Columbus has an aging population. Do they predict a younger population moving in to stay? And that dovetails into Nancy Nanny's question. With new jobs and more residents, younger residents, will we have enough public schools located to serve this population?
Well, I think that's part of the adolescent growth spurt that we're going to have to deal with. I did some work for Licking Memorial Hospital, helping them understand what the increase in the demand for their services from Intel was going to be. It is going to be a challenge. I think we're going to meet it, but we have to be prepared to put those plans of 3 million people into higher gear than we have been.
Next question.
Hi, Jeffrey Feld, Geosite, with a life science consulting company, me being the one employee. So we've talked a lot about the semiconductor industry, which I think is on the tip of everybody's mind, but from a selfish perspective, I'd like to hear both your perspectives on how the life science industry and healthcare is going to affect our economic outlook in the next year or 2 years.
Yeah, let me start with that. A great question. To me, when I look at kind of the top down of the economy and where do we have potential for growth and really productivity gains, it's really the healthcare sector. If you think about, so many other sectors have gone through that already, these productivity enhancing measures, and they can be painful, right? It could be more reliance on automation instead of workers. Although now I agree with Bill that this demographic challenge and shortage of workers isn't going away. So that does suggest more towards automation and computers, things like that. But to me, healthcare and the aging of the population, it just seems ripe for both of those sectors for tremendous growth. So I would, look for those to continue to, start to even contribute more greatly going forward. If you look at employment gains, actually, healthcare has been one of the sectors that has actually grown quite a bit, especially since the COVID pandemic. So it's not all leisure and hospitality jobs coming online. It's also been the healthcare sector as well.
That's one of the sectors that has been doing less well than average here. And again, I think it's primarily driven by the inability to find folks.
I just want to add that from experience being on the bench and off the bench, that automation is a great thing for life sciences. So it makes better jobs. So anyway, thank you. Great question.
So NPR had an article yesterday, or a story yesterday. Have we ever had a recession caused by reduced production due to the lack of employees?
No.
I don't think so.
I would say no. I will argue no. We haven't. This is brand new territory, right? So you have the demographics kind of colliding with also this post-COVID reaction, right? Yes, as baby boomers, retiring, and the demographics, we've known that for a long period of time, and that's secular. But we also had a lot of people who accelerated their retirement, 55 and older, who said, you know what, stock market's up, I'm doing okay, and this is horrible health conditions, and I'm out, right? Now maybe they'll need to come back. That's been the argument, right, for the last 2 years. Well, they'll have to come back, right? And they really haven't. And you see it in other age groups. Now, I would say the prime working age group, 25 to 54, that's almost back. So that's good news. But it's really been the 55 and older. So this is very, very unusual. And is a consequence of the fact that we don't have the same growth in the working age population. If you went back, to even the 80s, you would see that the employment growth was adding, at least 2% to GDP, right? Now it's probably about 0.5% at best. So it's a dramatic difference, and that's why we really need productivity gains to really propel our economy. And if you think one other comment I would say is that Japan is on the leading edge of this. If you think of Japan, look at them, you could get some sense of what the challenges we have. I think we're up to it. I mean, certainly Intel and semiconductors and technology is the way to go, frankly.
Well, and just a couple more points on building on that. I mean, let's face it, we lost more than 1 million people from COVID. So you lose a chunk of your working population with that. We continue to have extraordinary childcare issues. And you have to, I mean, these things are going to have to be addressed if we're going to deal with these issues. Do we have time for one more, Jane?
One more fast. So Melissa Fisher says, with Intel paying very well and potentially driving up wages for others, does overall cost of living increase for all of us in the area? And maybe that's tied also to overall prosperity rise for all of us.
Yes.
Cost of living.
Yes. Intel's high wages are going to force up wages here generally, and wages drive cost of living. Cost of living does not drive wages. So, yes.
Well, and we also saw this when Amazon started coming into the area with warehouses. Amazon was paying more than the other warehouses were, so everybody else had to raise their wages as well to deal with that. Okay, so we're going to turn things over to Kelly to wrap up.
All right, thank you. I hope you all found today's forum awesome as always, but also that you learned enough sound bites that you can go home and sound smarter or go back to work, however you need to do it. I also wanted to just say one more thing because we have another new member that I didn't mention earlier, which is Montez Mickens with MJ Photography and Videography. So welcome. Thank you for joining. We're super stoked to have you. And thank you for today's sponsors, BDO, Delta Airlines, Fifth Third Bank, and Ian Alexander Photography. Thank you to our virtual seat patrons and to the Center for Human Kindness at the Columbus Foundation and the Columbus Dispatch for supporting today's live stream. And our special appreciation to today's speakers, Kathy Bostjancic, Bill LaFayette, and our host, Mark Williams. Please make plans now. So see this room and how full it is because everyone is in Dr. Bill's fan club, I think. But if you're not already registered for next week, we are going to have another forum on Wednesday, the Democracy 2033, the Future of Democracy, with host Mike Thompson. And lastly, our thanks to each of you for being here. We really, truly could not do this without you. Have a wonderful afternoon and Happy New Year.